Forget everything you think you know about accounting. Seriously. It's not really about math or spreadsheets or taxes. At its heart, accounting is the universal language of business. It tells the story of every single dollar that's earned, spent, and invested. And today, we're going to teach you the basics of how to speak it. All right, let's just dive right in. To really get why this language is so powerful, you first have to understand the problem it was created to solve. And it's a problem that every single business faces. I don't care if you're a corner coffee shop or a massive global company. This is the question that keeps business owners up at night. You can be incredibly, ridiculously busy, phones ringing off the hook, emails flooding in, but all that activity doesn't automatically mean you're making a single cent of profit. So how do you actually know for sure? How do you cut through the chaos of just working to get to the clarity of your financial health? I think we've all seen it, right? Maybe even lived it. The classic shoebox just overflowing with crumpled receipts. Money's coming in, money's going out, but there's no system, no structure. It's just a mess. You can't make smart decisions when you have no idea what your financial picture actually looks like. This is the chaos that accounting was born to fix. So how do we bring order to all of this financial chaos? Well, it all comes down to one simple, surprisingly elegant, and totally unbreakable rule. This is the bedrock of everything in accounting, and honestly, it's pretty straightforward once you see it. First up, we have assets. Just think of these as all the valuable stuff a business controls. It's the cash in the bank, the products on the shelves, the computers, the delivery vans, anything of value. It's what you own. Okay, next up, liabilities. These are the complete opposite. They're what the business owes to other people. This could be a bank loan you have to pay back, or maybe money you owe to a supplier for materials you bought. It's all your debts. And finally, there's capital. You might also hear this called equity. The simplest way to think about it is this. If you sold off all your assets and used that money to pay off all your liabilities, whatever is left over, that's the capital. It's the owner's actual stake in the business. And here it is. The golden rule. Assets minus liabilities equals capital. Now, the most important part of this, the thing you have to remember, is that this equation must always be in balance. Every single financial thing that happens, every transaction, has to keep this scale perfectly level. It is like the law of gravity for business finance. It never breaks. So, if the equation is the golden rule, then how do we actually speak the language? Well, just like any language, this one has grammar. And the most basic piece of grammar in accounting is something called the duality concept. This brings us to a really beautiful, simple idea, the duality concept. It just means that for every single transaction, there are always two effects, equal and opposite. A business can't just get something for nothing. If you gain a new asset, you had to either give up a different asset or take on a debt to pay for it. It's a perfect give and take every single time. And the special words we use to describe these two effects are debit and credit. Now, please don't let these terms scare you. They don't mean good or bad or anything like that. They are simply directional labels, kind of like left and right. We just use them to record the two sides of every transaction to make sure our big equation stays perfectly in balance. So how in the world do you remember which way to go? Okay, here's a fantastic little trick. The mnemonic DEADCLI. It's super helpful. Everything on the left side, expenses, assets, and drawings, you increase them with a debit. And everything on the right, liabilities, income, and capital, you increase those with a credit. If you can master this one little table, you've basically mastered the grammar of accounting. All right, theory's great, but let's see how this stuff actually works in the real world. We're going to follow a brand new, simple business called Our Fashion, and just watch how every move it makes keeps that golden rule perfectly balanced. First things first, the business needs some cash to get off the ground. So the owner, Rajiv, he takes $20,000 of his own money and puts it right into the business bank account, a very simple, very common first step. So let's apply our rules. The business's bank account now has more money. The bank account is an asset. So remember, DEDCLIC, to increase an asset, we debit it. At the exact same time, the owner's capital in the business has gone up. To increase capital, we credit it. Look at that, 20,000 debit, 20,000 credit. The equation is perfectly balanced. Okay, next up, Our Fashion needs a way to deliver its products. So it takes $8,000 out of its bank account and buys a delivery van. Now this one's interesting because all that's happening here is an exchange of one asset for another. Let's break this one down. The business gained a new asset, the vehicle, so we debit it to show its value increased. But it had to give up another asset to get it, cash from the bank. To show the bank account decreased, we credit it. The total amount of assets the business has didn't actually change, right? It just shifted from being cash into being a vehicle. The scale is still perfectly balanced. Now, each one of these entries doesn't just get scribbled on a piece of paper. They're formally recorded and sorted into different categories called ledger accounts. The easiest way to think about it is like a digital filing cabinet. You've got a folder or a ledger for cash, another one for vehicles, another for capital, and this creates a complete financial history for everything. So, we're meticulously recording every debit and credit. We're sorting them into all these different ledgers. But why? I mean, what's the end goal of all this? The goal is to take all of this raw data and turn it into something that actually means something, the financial story of the business. You know, the entire accounting process can really be boiled down to these 4 main steps. First, we record the day-to-day transactions. Then, we organize them into their specific ledger accounts. After a while, we do a really important check called a trial balance to make sure it all adds up. And finally, we use that balanced info to build the big reports, the financial statements. And that third step, the trial balance, that is the moment of truth. It's where you list out the final balance from every single one of your ledger accounts. And if you've done your system of debits and credits correctly, the grand total of all the debit balances will exactly equal the grand total of all the credit balances. It's that final check for balance before you start telling the story. And all of this leads to the grand finale, the financial statements. These are the reports that finally answer those big questions. The income statement tells you, flat out, did we make a profit? The balance sheet gives you a snapshot in time of what you own and what you owe. And the cash flow statement shows you exactly where your cash came from and where it went. So at the end of the day, that's what this whole thing is about. We take the chaos of that shoebox full of receipts and we transform it into a clear, coherent story. A story of challenges, growth, profit, and loss, all told to the elegant language of debits and credits. Learning this language gives you the power to read and understand the story of any business, including your own. It helps you move from just being busy to knowing if you're actually successful. So, the only question left to ask is, what story is your money telling you?